For us in Sweden, Scan is a household name. It's where we buy our falukorv from, it's where we buy our meatballs from when we go to ICA and other supermarkets. However, it's actually based in Finland. We produce meat in over 11 different brands. We produce these in Finland, we produce them in Denmark, in Sweden, in Estonia, Lithuania, and Latvia. However, we do export to over 50 different countries worldwide. This whole business has a revenue of 1.8 billion euros in 2021, and one that is expected to grow. Hi Mom, just called to tell you that we just went through the ratios and the analysis and everything's looking fantastic. I might just be HKScan's best CEO throughout time, throughout history. Profitability, out of this world. Liquidity ratios, beautiful. Everything's looking fantastic. We're making bank. I'm so proud of myself and my team of me, myself, and I. This was a great year to be HKScan. So the Lund is coming now to just audit our books. You're gonna see how proud they're gonna be of me. And then Oscar, our biggest shareholder, he's going to be so happy when I present to him how rich he's going to become. What a life, what a world. Goodbye, mother.
We're representatives from Finland.
Welcome. Please have a seat.
Nice to meet you.
Nice to meet you.
Nice to meet you.
Nice to meet you.
After analyzing your company's results, we can say that your liquidity position is quite poor. To begin, the current ratio has not exceeded 1 in the past 5 years of operations. These figures indicate that for every 1 unit of current liability, there are fewer current assets to pay back the short-term obligations. This is a problematic figure as current ratios below 1 represent that HKScan doesn't have enough current assets for its current liabilities. In addition, there is no capital for you to invest in future operations.
Well, a factor that might have contributed to this low current ratio is the penal sanctions we faced from the Danish tax authorities, which was a result of the tax audit from 2011 to 2020. And just in the last quarter of 2020, we reported an item of minus 3.5 million euros, which affected our comparability. And I can see that here. It also includes 3.3 million euro repayment of energy tax refunds to the Danish government, as well as related legal and consulting fees. It sounds like we've got a lot to talk about.
We sure do.
Should we head on over to the conference room and discuss this?
Sounds good.
All right, let's get to it.
Yeah. Well, compared to your competitors, the 2022 current ratio of Danish crown is 1.457, and the current ratio for Cranswick is 1.542. HKScan's current ratio is thus significantly lower than its competitors, which further suggests that your company is in a poor liquidity position. Another indicator, number of days sales in inventory, has increased from 2018's 25.284 to 2022's 28.748.
Oh, and don't forget the interim report.
Right. Your interim report for Q3 2022 stated the group's liquidity position is satisfactory. The claim stated in the report is not fairly presented for various reasons. Firstly, the current ratio of your company is under 1 for the last 5 years of operations, whereas your competitors have had a current ratio of 1.4 in 2022. Nextly, the increase of number of days sales in the inventory. These figures can be improved considering HKScan's industry in selling perishable goods. It is also evident that your company has become less efficient, which further indicates that your company is in a poor liquidity position. Due to the purpose of corporate reporting, you may have falsely claimed that you are in a satisfactory position for liquidity. But the reason behind this is you might want to influence stakeholders such as the bank, as you know that you are more favorable in receiving a loan if your company has a satisfactory liquidity position.
According to our findings, see in Appendix 2,
Right.
The debt to equity ratio has been progressively increasing over the last 5 years from 1.85 in 2018 to 2.18 in the last 12 months. Because debt is typically riskier, investors and lenders tend to favor businesses with a lower debt to equity ratio. Therefore, a company with a higher ratio than the industry average would have more difficulty accessing debt financing. The optimal ratio can vary within different industries. However, it typically shouldn't be significantly higher than 2. HKScan has a ratio of 2.18 in 2022, which, based on the data, is as a result of a 23.8 million euro increase in interest-bearing debt in 2021. Additionally, the debt to equity ratio increased from 1.87 in 2019 to 1.96 in 2020.
That is true, but what that doesn't consider is the fact that that's due to an investment in 2020, which we did into our plant in Lund. And that cost the company 37 million euros. And to fund this investment, we obviously needed to access finance, and we had the choice between debt or equity. So the increase suggests that we required more debt financing to fund this investment.
I see. We can see that Cranwick, one of your competitors, experienced an increase in debt to equity ratio from 0.36 in 2018 to 0.48 in the last 12 months. You can see that there's a rather big gap between the numbers for your company and Cranwick. This indicates that the company uses 0.5 cents of debt financing for every €1 of equity financing. This is a significantly lower ratio compared to HKScan, which indicates that Cranwick bears less financial risks.
True, however, it doesn't indicate that HKScan has insufficient solvency, because although debt brings risk, debt could also bring a higher return on equity. Additionally, the higher ratios seen in HKScan could be explained by the loans that we used for our long-term investments, such as the Lund plants.
HKScan has a times interest earned ratio of negative 1.653 between Q1 and Q3 in 2022. This indeed lower than other competitors in this industry. In the same year, Danish Crown presented a ratio of 11.096 and Cranwick of 30.703. HKScan's ratio did decrease from 1.029 the year before.
And this is due to a fall in our earnings before interest and taxes by 38 million euros. And this was partly due to the spread of the COVID-19 pandemic, which triggered high inflation. It also affected the energy prices, especially so this second half of the year. Regardless, compared to just 3 years earlier, in 2018, our ratio has improved.
In terms of the investment analysis, I calculated the enterprise value to the EBITDA ratio and the price to earnings ratio to understand the trends in HKScan's performance and the valuation of the company.
I see.
By observing the data, your company has experienced a negative trend over the last 5 years. The enterprise value to EBITDA ratio decreased from 39.4 in 2018 to 5.8 in 2022. This will imply that also the value of the company has decreased. From a potential investor's perspective, it could be interesting to invest in a company considering that the latest EV to EBITDA ratios are low, especially compared to Cranwick's results, your competitor.
Well, that sounds like good news to me.
It would seem so. However, at the beginning of 2019, the company launched the turnaround program with the aim of improving the financial situation and reaching healthier profitability levels.
Indeed. Well, by looking at the ratios, one can see that HKScan is undervalued compared to Cranwick.
Exactly, that's one of the perspectives. But on the other hand, by taking a closer look at the financial statements, Cranwick has a far better strategy and management, thanks to which they can have a stable net income of around 25 million euros. HKScan has had a consistent net loss in the past 5 years.
Carl, would you agree?
Yep.
Good.
So, like most of your ratios, in regard to the profitability of your company, there are several problems. Even though, as we mentioned before, your net income has seen a growth in the last 12 months. The gross profit has significantly worsened from 6.1% to 3.9%.
Which you can see right here.
And you are once again operating at a considerable net loss with a negative profit margin of 1.4%. That means that for every euro you make in net income, you operate at a loss of 1.4 cents. This is comparable to a poor performance in 2018 and 2019, which is very surprising considering both 2020 and 2021 were two very good years in terms of your profitability. Why is that?
Well, as you said, we did have a net income growth, which we're very happy and pleased about. And this was mostly due to us, A, increasing the prices of our products, and also B, performing in a more efficient manner, simply put. However, this was unfortunately offset by high cost inflation, especially within the energy and logistics sector, especially true in the third quarter. And now we're just focusing on short-term measures to improve our profitability and our overall cost management throughout the whole company.
Okay, I'm just thinking that both of your competitors, Danish Crown and Cranswick, still performed similar to that of the previous years. Were they not affected by the high cost inflation in energy and logistic costs?
I must admit, this is true. Hopefully, we will see the change in the coming years, hopefully even quarter.
Perfect.
Well, I thank you guys for coming. This has indeed been very insightful. It seems like I have some bad news to deliver to our shareholders.
Thank you very much.
Thank you so much.
Good. Hey, thank you for waiting.
No problem.
We have some discussing to do. This there.
How's family?
Well, living doing better. Thank you for coming today, Oscar. We just had Lund over for our annual review.
Good news.
Unfortunately, I'm going to disappoint you today. They did present their annual findings, and they are disappointing. We've seen our profitability, we've seen our solvency, our liquidity, and our investment analysis all come up negative, at least compared to previous years. We, especially compared to our largest competitors, Danish Crown and Cranswick. Unfortunately, we have both internal and external factors to blame for this, amongst others, high inflation, the war in Ukraine, etc. But I want you as an investor to know that we are trying to redeem ourselves by increasing our sales price, as well as operating at a much more efficient rate than previously.
Well, I expect that you and the management have some sort of strategy to actually efficientize these costs instead of just saying it.
We do, and we hope to see the effects shortly.
Well, I'll see you at the next investment meeting.
That's
I hope for better news then.
Me too. Thank you for coming.